Welcome to the Square Exchange community. In this session, we will be looking into our first technical strategy that can be easily used to generate weekly profits. This strategy requires a greater conceptual understanding of support and resistance levels, trend lines, and the Fibonacci retracement tools. Therefore, I will highly recommend you guys to watch our previous videos on these topics before jumping into the application of the strategy. After going through the examples presented in this video, you will be equipped with a tool that can be easily used to create profitable trades. So let's jump right in. Before jumping into the topic, I would like to ask you guys to hit the subscribe button, as that will be the most convenient way for you to follow what we are doing. Developing and following a trading strategy is very important in the equity markets, as it is very difficult to consistently generate profits. As a matter of fact, around 97% of all retail traders fail because of the lack of an effective and back-tested strategy. Most professional traders, even in the most acclaimed banks, boutique firms, and freelance consultancies, have a trading strategy that they rely on. The most important attribute of trading strategies is that they help traders to be disciplined, confident, and consistently create profits in the most volatile markets. The reason why most of the retail traders today fail miserably is that they either do not have a strategy in place or they mistake a technical setup of a few indicators to be an efficient strategy. The strategy that we will be talking about today is the first in the list of 6 strategies devised by our equity analysis team. Our strategy has been carefully backtested to work across all time frames and different equity markets. It only requires you to develop an adequate understanding of the following indicators and strategies: the Fibonacci retracement tool, trend lines, and support and resistance levels. I will suggest you guys to take a look at our previous videos on trend lines, support and resistance levels, and Fibonacci tools to understand these indicators and strategies independently before jumping into the application of the strategy. To understand the strategy in the most efficient way, I will be using real-world examples. We will start by taking the example of American International Group on a 1 hour time frame. I would always recommend you guys to start by evaluating the ongoing trend, as it will help you to forecast the, the price in the future. The first step, as always, would be to draw trend lines. As you can see in this case, it would be something like this, and I always recommend to start with trend lines because they allow you to understand the ongoing trend and forecast the areas that might result in a potential breakout or a pullback. And as a matter of fact, they also help you identify false breakouts. So in this case, as you can see over here, the trend line is able to encapsulate all the swing highs and literally encapsulates the entire bearish trend within itself. The step 1 also actually opens up the room for us to identify our entry points. And as I have previously mentioned in my videos on trend lines, that the entry point must always be after the first candle in the direction of the uptrend that sustains above the trend line, which in this case will be this long bullish candle. So I actually recommend to do this because this confirms the start of a bullish uptrend. As you can see in this case, if someone would have tried to place or trade in this during this candle, the price could have potentially fallen down and it could have simply been a false breakout. But since one candle actually sustains above the trend line, even though we see a short bearish trend, the price takes support from the trend line and literally shoots up. So with that being said, this would be our entry point. Now let's move on to step 2, which would be to evaluate the immediate support levels for the trend that we have encapsulated within the trend line. In this case, we can find the support levels based on the historical trend of the price, which would be between the price levels of $29.65 all the way to $28. And we can mark these levels using the price channel. With that being said, step 2 actually helps us to identify the important stop loss levels that need to be placed before entering the trade. I will also take a minute to explain what a stop loss is in order for you to have a greater understanding of the term. A stop loss is a price level that is predetermined by the trader while placing a trade in order to limit his losses. This feature allows the trader to secure his position and does not have to monitor his position daily. The only limitation being that short term fluctuations can trigger an unnecessary squaring off of your position. Therefore, I always recommend our clients to place their stop losses a couple of bucks below the support levels in order to escape the short term fluctuations. And in this case, a stop loss level between $27 to $28 would have been an ideal stop loss level. With that being said, we have been able to determine the trend line, forecast a potential breakout, identify an ideal stop loss level, and now it's turn to find our exit points. Predicting a market trend is almost impossible. Therefore, there's no guarantee of what will the highest point be after a potential breakout. However, we can always forecast and try to analyze the most plausible price targets using the Fibonacci retracement tool. Step 3 would involve finding the resistance levels using the Fibonacci retracement tool. As discussed in the previous video on Fibonacci retracement tools, the starting point must be the highest point attained by the stock before the bearish trend reversal, and the ending point must be the lowest point attained by the stock during the bearish trend. And um, as you can see over here, if the trader would have used the Fibonacci retracement tool, he would have been able to identify resistance levels, actually very strong resistance levels at the 0.618 ratio level and the 0.5 ratio level, and would have realized that these could have possibly acted as the important exit points for the trade. With that being said, step 3, which basically involves us to use the Fibonacci retracement tool, help us to identify the important resistance levels that the price might hit and would have difficulty breaking through, and help us to identify the exit point that can help us to be the most profitable and exit our positions at the most effective areas. I would like to direct your attention to this blue line over here with this small rectangular box over here. So as you can see, I'm currently at a profit of $330 for 100 shares at American International Group using this strategy that I've just laid out for you guys. So with that being said, let's take another example for greater understanding. Let's take another example for greater understanding. So we will be looking at the 3M company on the 1 hour time frame as well. And if we would have been able to identify this short bearish trend, we could have encapsulated and made profits of up to anywhere between $10 to $11 per share. So I will be using the same strategy, therefore I will be following the same sequence of steps to perform my technical analysis. If we would have identified this bearish trend, we would have started by drawing a trend line, which would have been something like this. And as you can see, it encapsulates all the swing highs in the bearish downtrend. And we could have said that this candle could have possibly been the confirmation of the bullish uptrend, as it was able to sustain above the trend line, and this would have been our possible downtrend. So moving on to step 2, in this case it would have not been as important, but just as a good practice, I would suggest you guys to always draw support lines and support levels before placing a trade. So in this case, it would have been anywhere between, I would say, between $152 to $151. And then, as I've said, that it's always better to place your stop loss a few bucks below the support level in order to escape the market fluctuation. So I would say anywhere a stop loss of anywhere between $151 to $150 would have been an ideal stop loss level. With that being said, step 3 would have actually required us to draw the resistance levels using the Fibonacci retracement tool. And as I have said previously, we start by placing the starting point at the highest point attained by the stock before the bearish downtrend. and the ending point must always be at the lowest point attained by the stock during the bearish downtrend. So as you would have seen in this case, the stock pretty much rode along, and it was kind of a vertical jump. There was a gap up opening, and the price literally shot up. And none of the Fibonacci ratios up till the uh, ratio of 1 actually acted as a strong resistance level, as it was easily able to break through. With that being said, I would always recommend you guys to close your position after a stock breaks through the complete Fibonacci pattern, because it's always safer that way. And the Fibonacci ratios are can be effectively evaluated and are credible only up till the ratio of 1. Anything above that can be risky. So I would have suggested a partial close of your position somewhere around this region if you were still positive of the downtrend. And a smart trader could have actually partially closed his position over here, would have seen that the stock took support at this level, and could have actually increased his stop loss level and could have placed it anywhere between 156 to $155, which is between the 0.5 ratio and the 0.618 ratio levels. And that would have given him another, and once he would have actually seen this bullish move, and this also gives me the opportunity to temporarily draw another trend line in this area. And as you could have seen, this would have been a confirmation of a bullish uptrend, and there could have been a short bearish downtrend, but the stock took support on the trend line and then literally shot up to take and you could have booked profits of anywhere between 60, like a few more a few extra bucks on the ongoing bullish trend. With that being said, I guess this strategy has a lot of subsets to it and can be implemented again and again during a long bullish trend, as we could have seen in this case. So you could see that there was a bullish trend, the price consolidated, it fell back a little bit, but if you would have increased your stop loss level and would have done and followed the same strategy again and the same sequence of steps, you would have analyzed this to be another confirmation of a bullish uptrend, and the price would have taken support and shot up again. With that being said, this strategy can be implemented multiple times in an ongoing trend and is very sustainable and very reliable across all time frames. So with that being said, that's all we have on our first technical strategy. I hope this video was beneficial, and if you guys want us to create a video on any specific technical indicator or strategy, please leave a comment in the comment section and we will be happy to do so. Thank you for watching.